You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
While 2020 has been a really difficult year for a lot of people, we've also been given some unique tax provisions through the CARES Act that you need to take advantage of before the year ends, and that's really soon. But you'll also find out that you have a little more time than you might have thought you had. I'm Kathy Fettke, and welcome to The Real Wealth Show. Today's guest is a successful attorney, business owner, and real estate investor, and he is an expert at helping people minimize risk and maximize income, which is really needed here in 2020. Oh, Toby, welcome back to The Real Wealth Show.
Hey, thanks for having me.
You promise you'll make this interesting. We're talking about taxes, and we're going to be fascinated the whole time, correct?
Absolutely. Taxes are absolutely fascinating.
Well, there has been a lot of projection about what people think will be happening, but what currently is in play and what do investors need to know about as we wrap up 2020?
Yeah, so the big ones, obviously there's questions about the Biden proposals, and I'll hit on those. But what we don't know for certain is that there's a number of provisions under the CARES Act that are going to go away. And specifically for different types of investors, if you qualify as a real estate professional, you need to keep your eye on net operating losses because they go away for the ability to carry them back 5 years at the end of 2020. That's a big one.
I think what you're saying is we need to spend some money?
What you want to do is either spend some money or really look at whether you want to accelerate some of the depreciation. Mm-hmm. And you can actually make that decision all the way up until you file your return. So it could be something you do over the summer in your leisure while you're drinking a pina colada. You could say, do we want to accelerate, take some loss and carry it back 5 years? Do we want to create a bunch of loss that we can carry forward in case the tax cuts, or excuse me, there's tax increases? Because the Biden administration has proposed a lot of things that would actually increase somebody's taxes if they're above certain income points. Quite extreme, actually. If you're making over $1 million, you could be looking at your capital gains rate turning into 39.6. You could be looking at having your dividend rate turning into 39.6, plus the net investment income tax. You're over 40%. It's actually a really high, and that's before your state tax as well. So some folks could be looking at a 50% plus, as opposed to, hey, should I harvest up some losses, carry them forward to offset some of those things so they don't happen in the future?
Okay, so tax planning sounds really important, and we don't have much time to do that. Although you just said that we might, if we file a late tax return, we have till when to figure this out?
Well, this is what's interesting, Kathy, is that a lot of folks think that your taxes are due on April 15th. Let's just use that as the example. Your tax payment is due, and you can avoid even penalties if you pay 100%, 110% of the previous year. Like there's some things you can do to avoid penalty, but your tax return technically is not due until October 15th. You have an automatic extension of 6 months that I recommend people take because there is tax planning you could still do. You shut the door when you file your return. On a lot of it. On certain things, like a change of accounting election, where we take a building or we take a piece of property that's 27.5-year property, right? And we look at it, and in theory, you're writing off the carpet over 27.5 years. And we know carpet's not going to last 27.5 years. You could actually choose to take that section, it's called cost segregation, take that portion of the asset of the structure and separate out its personal property components, like things like some of the plumbing, some of the electric, some of the like carpeting and paint, those types of things, and you could depreciate them much quicker. You can actually make that election up until you file your tax return. And technically, if you file early, if you file on April 15th, you could still make a change on it. You could still amend and do that on that type of thing. Other provisions aren't so flexible. So for example, if you have a 401k for your business, the company can make contributions on my behalf all the way up until it files its tax return. And I file mine. So if I file a tax return, my company files its tax return in March and April, I just shut myself out of the ability to continue to do planning that affects me for last year. And so I always recommend that you take advantage of that extension so you give yourself as much time as possible before you file your final return. Doesn't mean you don't pay your
It's great that you're saying this because we have, as you know, we do a lot of syndications.
Mm-hmm.
We raise money for large developments. We're talking about hundreds of investors usually in that one development. And sometimes we just can't get the K1s out so that they can file by April, and they get really upset. Like, don't make me file an extension. And my comment is, why not? We always file an extension. And I thought it also helped prevent, I don't know if it's true, but prevent audits, or at least put it off. Is there any truth to that?
There's a function that the IRS uses, kind of an algorithm, and the idea is that you remove yourself from the audit pool. What I'll say is this: I don't know if that's true, but the data tells me that filing an inaccurate return that is not consistent with a K1 or another tax filing will cause you to get audited.
Mm-hmm.
And so your situation is what we see all the time. K1s are oftentimes amended over the summer. So somebody will get something out because they have to. And then as they go through their financials with their financial advisors and their accountants, they'll say, oh, wait, this is actually a repair. It wasn't an improvement. So we're going to deduct this.
Mm-hmm.
Oh, we have the ability to treat this in another way. We're going to take that so that we can pass down more loss to the investor, for example. Well, if you make that change in June and somebody's already filed their return based on the first K1, they're going to have to amend their return now.
And that's an audit flag, I'm guessing.
That's, the filing an amended return doesn't necessarily trigger an audit, but what will definitely trigger the audit is a K1 that does not match up. They'll just run the numbers and say, hey, this K1 says something different than this one. And it'll at least trigger a correspondence audit.
Yeah, I 100% agree. Just wait. There's not really a downside to waiting to file, right? To extending.
I could give you example after example, but when option trading, when they had to report their basis, and so this was about, I want to say 4 or 5 years ago, all of these financial institutions were kind of using the same software, and they were all incorrect. So they issued out all these tax statements to their investors. And we're talking like the big guys, TD Ameritrade and all these guys, and they had to amend them. So anybody that filed their taxes on time now has to go back and amend their tax return, or or they're going to have an inconsistency that's going to trigger some sort of audit. It was actually pretty horrific, and people are just mad as hops because they go back to their accountant and say, I need to do an amendment, and the accountant says, I'm going to charge you for my time.
Sure. I mean, more to do.
And it costs them more money.
I have personally found that the best time to talk to your accountant is after April, right? Because they're so busy before.
Absolutely.
You're just better off having that in-depth conversation sometime over the summer when they've taken their vacation. Almost every CPA I know takes a vacation on April 15th just to get out of the office after the crazy first 3-4 months of the year. So, yeah, we usually meet with them right around June, July, and sometimes in August.
The perfect time to do it when now you are able to look at your numbers, you know what they mean, and now you can explore options.
Mm-hmm.
If you close
and the
door,
CPA isn't so stressed out.
Oh yeah, right before that, it makes no sense that we have a system like this. Hey, let's have 100 million returns due on the same date. Let's not stagger them at all. Let's just make them all due.
Oh, there's all kinds of things we could talk about there, but what other kind of, well, again, let's zoom in a little bit more onto this topic of accelerated depreciation. So a lot of our listeners invest in 1 to 4 units. Many, maybe some also invest in apartments. Can you do the same tax laws apply to both?
Yes, absolutely.
Okay.
Yeah.
So on a 1 to 4 unit, what can you accelerate in depreciation?
All right. So you're going to break out the cabinets, you're going to break out sidewalks, fences, all those things are going to be less than the 27.5-year time frame of the structure. Certain portions of the plumbing, electricity, those will all be broken down. the things like the carpeting and the fixtures, and they get broken into their components, either 5, 7, 15-year property, or that everything else is defaulted to 27 and a half. About 30% of that structure is probably going to be, on average, a little bit more than that actually on average, it's going to be those personal property items. And then you have an option to accelerate that or just let it be as it may. You could accelerate and say, I want to take in 1 year all my 15-year property, or maybe all of my 7, or all of my 5, or all of them. So $1 million, let's say you have a fourplex, $1 million, you're looking at about a $300,000 deduction in year 1.
So it just really depends on how you did. I mean, if 2020 you didn't make any money, you wouldn't want that, right? You wouldn't want those deductions, or would you?
And that is something that you look at. We always see people trying to get to 0.
Mm-hmm.
And I say that may not be the best idea.
Mm-hmm.
What you want is really to keep your taxes below a certain threshold. Maybe 20% is something that you're comfortable with, maybe 25, 30%, depending on your income level. But you don't want to get hit at 50, right? And so we don't want to go all the way down to 0, because maybe that's going to impact our lendability. Maybe lenders start looking at you with a raised eyebrow. And maybe because you went 0 1 year, you're going to have a whole bunch of tax the following year. And now you're pushing yourself into those higher brackets. So you do want to be cognizant of kind of bracket management. And realistically, a lot of folks don't get the benefit of all that loss anyway. Because it's passive for many people unless they do qualify as a real estate professional. And so those passive losses, we can't use it against active income, ordinary income, or capital gains. You can't use it against it. So it just sits there and carries forward until you dispose of the property. So there are people where you look at it and you say, should I even be accelerating? I could say that in probably half the situations I would accelerate, just so I don't have to pay tax on any of the rents. If somebody's making $50,000 a year and they have $20,000 of rents, that's a lot different than somebody who's making $500,000 a year and has $200,000 of rent. Like, I want to offset that $200,000 because it's being taxed at such a high rate. The person who's in the 22% tax bracket may be okay recognizing.
So in our last house, we found out California laws, of course, and regulations are pretty intense. We had to put in a new septic, and that in California is a lot of money. It's probably 3 or 4 times what it might be in other places. And so we tried to sell the property and we couldn't. So we rented it. And now all that work gets to be deducted, right? Or can we accelerate the depreciation on it?
You would be a real estate professional, so you could actually create a loss for yourself and offset W-2 income or other types of income.
So it's much better to do those kinds of things on a rental, which is if you have big capital expenses coming on your primary, you might want to rent it out for a year and do it then. Is that true?
That is absolutely true. So that is an interesting point, by the way. So for folks that are in certain areas of the country, like Manhattan, maybe not so much Manhattan anymore, but the Bay Area, where you've had huge appreciation of personal residences, a lot of people are stuck thinking about the personal capital gains exclusion, section 121, where they can sell a house, married couple can avoid $500,000 of the capital gains. And let's say you have a house that's worth $2 million, you paid $500,000. That means you're going to pay long-term capital gains on $1 million. And in California, that's not anything to sneeze about. That's highest bracket. That's 20% plus 3.8 plus 13%. So you're talking about a sizable tax hit. And if you just put it into service as a rental property, waited 6 months or so, and then sold it as a 1031 exchange, you get to take your 121 exclusion. You still get that $500,000 step up in basis, and then you roll that into new property. You do have to, follow the 131 rules or 1031 exchange rules and buy more real estate, but you can avoid the tax completely. So that's in that situation, that'd be about a $300,000 win or a $350,000 win. And the only difference is knowing that it exists. Most people would say, oh, wait a second, $300,000 or I rent it for 6 months? Are you kidding me? I'll rent it and then sell it.
I thought you had to rent it for closer to a year, but I guess
There's no hard and fast rule. You have to convert it into a rental. And so there's actually cases where people weren't able to rent it. But as long as they put it onto the market at fair market rents and made a reasonable attempt, it will turn it into an investment property. Yeah, the IRS is kind of interesting. They always look at your intent. And so if you just make it into a rental for a small period of time, probably not going to work. But, again, if you're looking at that scenario and you're looking at that much money, maybe you go the conservative route and say, I'll make it into a rental for a year. The rule for the $500,000 capital gain exclusion, keep in mind, it's only capital gains, it's not depreciation. The capital gain exclusion is that you lived in it as a primary residence 2 of the last 5 years. So you could sell you could rent out your residence for up to 3 years, sell it, and still get that $250,000 or $500,000 exclusion, depending on whether you're single or married. It's pretty potent, and it makes a huge difference. And people always when we talk about it, that's usually when I get somebody doing I could have had a V8 moment. And they're like, are you kidding?
That is gold. That is gold. I can hear the people who love us right now, and I can hear the people who hate us right now. Let's talk about loopholes. I was on a live broadcast with about 1,000 people the other day, and I talked about loopholes. And there's what is it? How do you define a loophole? Is it something that's sort of a gray area, or is it just simply tax law that people don't know about? Totally legal, but people just don't know about it.
Yeah, loophole has a negative connotation. What I look at it is the IRS. The way it works is Congress writes the law. The Treasury is the collector of it, and they'll oftentimes write interpretations, and the IRS will get together and write interpretations. They'll give incentives for certain types of behavior. So, for example, during the downturn, the recession, they incentivized developers to build more property because we needed more properties. And in order to incentivize them, they did bonus depreciation, which says, hey, if you have certain types of property, you don't have to wait to write it off over its useful life. You can write it all off in 1 year and take a big deduction. And not only that, will allow you to carry it back, and we'll let you go get some of the taxes you paid 5 years ago, 4 years ago, 3, 2, 1. We'll let you carry it back and get back. And that's a big incentive, and it incentivizes people to do building. And so our president, for example, used that provision, went back and got millions and millions of dollars that he says he prepaid taxes. No, he paid taxes, and then they gave him back. But he used the deduction that he would have used in the future, and they said, hey, go back and get some of the money. They did the same thing under the CARES Act. And this is the act that they passed on March 27th of this year to try to soften the blow of all the lockdowns and the effect of COVID on the economy. They just created incentives, and I don't see a negative connotation. They also said, hey, you can write off $300 above the line on your taxes. Like, you don't have to worry about standard deduction versus itemized. $300 you can give to any charity. See, they incentivized a certain action. They also said, hey, Kathy, if you're a big giver this year, you don't have to worry about 60% of your income as a deduction for your charitable giving. You could give away 100% of your income this year and write it all off. So they put in all these incentives. And so somebody would say, oh, there's a loophole. No, it's an incentive. I could literally create my own 501c3. And this is what's bizarre. And this, I don't know if you know this, it'll be kind of fun to see your reaction. IKEA, the big furniture store, has been and always will be a charity.
I didn't know that.
It pays almost no tax.
Oh my gosh, no, I did not know.
Because he likes interior design, right? The actual cause, like, it's owned by 2 big foundations in different countries, and then the family has a small portion of it.
Wow.
Lots of things qualify as charitable activity, including real estate. Obvious ones are residential assisted living, veterans housing, housing for low to moderate income housing people that are mid-level, qualifies as a charitable activity. So this is really bizarre for people to get their heads around. You could literally set up a charity that does housing, and you could give it your houses or a house and write off the fair market value of that house if you purchased it more than a year ago.
Oh my goodness.
Yeah,
Wow.
once you start realizing, they would call that a loophole, right?
Yeah.
But it's incentivizing certain behavior. Like
Right.
in this particular case, it's incentivizing you to make sure there's affordable housing. And most people think of it as HUD, but it's the HUD list, and it's not 100% of it either. It's just a portion of it saying, hey, if you are a real estate landlord and you're going to buy and hold, we want you to make available properties that aren't just selling A class, but are for the rest of us.
Mm-hmm. Which is what we focus on.
Yep. And it works great. And so I'll give you a real life example. Somebody makes $1 million and they're like, Toby, I'm getting killed in taxes. And we have a housing nonprofit set up that they've had for a couple of years. And it's like, we look at the real estate and you say, here's one that you've owned for 20 years. You've got most of the depreciation out of it, but it's gone up in value. You bought it for $250. It's now worth $500. Donate the $500,000. Okay. You're going to have a little bit of a limitation. It's a 30% adjusted gross income limitation per year. So they're going to get a $300,000 deduction this year, which is going to be worth, in their particular case, was worth around 40%. So they're going to get a cash in their pocket benefit of about 100, whatever it is, 120,000, maybe it's more than that. But it's a sizable chunk, and they're going to carry forward the rest of that money and take it the following year and get another amount. So the total tax benefit to that individual might be $200,000, but they still have the house in their control. They can't just sell it and take the money anymore. It would stay inside the charity and they could pay it out as wages or whatnot. I see this working with our clients. It almost all goes into that charity. It works really well. And if they wanted to write off more, they could write a check, and we could do that on December 20 or 31st. We could just say, hey, I'm going to write it a check for 100,000. It saves me 40. So now I have another $100,000 and a house sitting in this charity, right? You're still deploying it. You're still able to buy real estate. You're still doing all those things, but now you're in a tax exempt zone. People that do that tend to get rewarded. And that's where we look at high income earners, especially W-2 earners. Their accountants always tell them there's not much you could do. Maybe we could do a health savings account. Maybe we could do, hey, put more money in your 401k, right? They always come out with these basic things. That's not going to get you much juice. This will get you some serious juice. If you're a W-2, you can give it away. And now I'm not saying everybody go out and do a housing charity. You have to be a giver, number one, and it is no longer your property.
Your intent is very important there. That it's not just tax savings.
Absolutely. But there's a lot of people out there that do a lot of good work, and they don't realize that thing that they're doing anyway, because they're natural givers. They're always helping. Maybe they do things in their community and they don't ask for any tax benefit. You could set that up and you could get huge tax benefit.
Well, that's exactly what RealWealth has been doing. We could be selling $20 million homes in Malibu, but we're buying, dilapidated homes, fixing them up, making beautiful, affordable homes for people that are cheaper than it would cost to build it. So it is a service that we've been doing for 20 years, trying to provide affordable housing. And of course, investors will benefit. I hadn't thought of this. I think this is going to be huge for us, and we need to talk about it in the future, because a new law passed in California, you may or may not be aware of, where when foreclosures come to the market, if an institutional fund comes in to pay cash for that, there's a 45-day period where an individual gets priority if they can pay a little bit more, which I think is a good idea, because last time the institutions came in and bought everything and the individuals couldn't get it. However, most individuals won't have the cash. If they're trying to get an affordable housing, they don't have the cash the way an institutional would. But the kind of loophole again is that a charity can do it. So a charity can come and outbid the institutional, at least the way I understand it. So we were looking into that anyway. And then we can continue to provide that affordable housing, get those fixed up, and then someone can come in and either buy it or rent it. So, wow. Okay. Oh my gosh. We could just go on and on and on. What else do we need to know
Oh,
about the CARES
I
Act
could
and
go
what's
off
running
on
out.
that I could go on a tangent. Here's the thing that you want to know.
You can for a second. You can.
No, because if a qualified nonprofit that does housing in about 2 years could qualify under HUD, and then it takes primary. It actually gets the HUD houses along with government agencies. So you actually buy it before it goes on the market.
Wow.
And they'll give you incentives they'll do everything from providing funds to help. Just think of land bank where the city.
Let's do it.
It's so cool. Like, I love that stuff. I love affordable housing because I think we are in dire need of affordable housing. It's redunculous. We have a waiting list here in Las Vegas of 67,000 people for HUD vouchers.
Oh, wow.
Crazy.
67,000. That's amazing.
So I say, get on your horse, buy some properties, make sure that they're available. We don't always go and do the Class A, right? Sometimes we need good, affordable housing for families. We don't always have to make millions of dollars selling it. I prefer to keep it and get that cash flow.
Mm-hmm.
Shifting gears towards tax. All right. So the Biden proposals are kind of scary. Going from a 21 to 28% corporate tax rate, having what's called old age disability and survivors insurance. People know it as Social Security, being assessed on income over 400,000. They want it to come back after it phases out. Those are big ones. They want to change the capital gains rate, the highest capital gains rate, to 39.6. They want to get rid of the 35 and 37% tax brackets and make it all 39.6. Those are kind of the big things. They want to get rid of 1031 exchanges, which everybody here should perk up and make sure that doesn't happen. It's been around for about 100 years. We want to make sure that doesn't go away. They do want to allow some of the estate tax benefits to phase out, meaning that right now, a little over $11 million per spouse can avoid federal estate taxes, and they want that to go to about $5 million. There's a few things like that. They want to get rid of the step up in basis, which is pretty huge, especially where you're at in California. One spouse passes, the house is no longer taxable if you sell it. And they want to remove that and have the basis inherited. So there's a lot of things that are there.
One spouse passes?
In a community property states like California, Nevada, I think Wisconsin, Washington, there's a few. If one spouse passes, the basis on capital property steps up to its fair market value on the date of passing. It's not the same in separate property states where only half of it will step up. That property's the part that the decedent, the passing away spouse, would only that half. And so, like in California, the whole amount will step up. So that's, if you have a whole bunch of stocks and things like that, a lot of real estate, then in theory, when mom and dad pass, everything steps up to the whatever the value is of those properties on the date of passing. And for investment real estate, it means you can redepreciate it. So, wow. Mom and dad buy something at 300,000. They depreciate it over the years. When they pass, it's worth 800,000. You're going back in and you have a new basis to redepreciate. So when the kids inherit
at 800,000, so you're not paying the taxes on the $300,000 property.
Yep. That's exactly right. And so if I gift it, this is a big one for some of you guys. I know this is going around because attorneys are great. They like to do doomsday stuff. Oh, you got to give your stuff away. The estate tax is going to shellac you. Just know that your basis goes to whoever you gift it to. So if I give a whole bunch of stuff away because I'm afraid that the estate tax is coming back, I give up that step up in basis.
You've just given your tax burden to whoever you gifted. Right. I went through that. I understand.
On another note, you can make that work for your benefit. So people call these loopholes. I call it being logical. If you have parents, for example, that you're taking care of and you're a high income earner, Don't sell stock and give them money. Give them the stock. They get your basis. So if you have low basis stock, let's say I paid $100 for Tesla, now it's worth $600. There's $500 a gain. If you give it to your parents, they may pay zero capital gains. They can make up to $80,000 and have zero long-term capital gains. Give it to them. Let them sell it. Instead of you selling it and paying, you're in the highest bracket and you're getting shellacked with the tax, and then you're paying for things for them. No, give them a low basis asset. They get your basis. So it's just being smart about stuff and having somebody that actually knows what they're talking about, so they can kind of say, hey, don't do that. This is the ramification. Do this.
Yeah, you really need someone like you to look at every financial move you make before you make it. There's things you just don't know. You don't know.
Yep. And it doesn't have to be horrible. It could be fun.
Absolutely. Yes, absolutely. Very good. And it does cost money, but it's going to probably cost a lot less money than the surprise you might get later.
This is what I always say. Taxes should pay you about $1,000 an hour. If you spend a little bit of time on your tax situation, on average, it's going to yield you about $1,000 an hour. So you decide whether it's worth it to spend some time. Some of you guys, it might be more. I had a couple where it literally was one form filed with their tax return and it saved them $170,000. It was like, you can make this election. Sometimes they just don't know. Or if you're a doctor and you have your own office building, you don't have to be a real estate professional. We can group those two activities, even though one's active and one's passive. You can still do it and take that loss against your practice. So some people just don't realize that stuff. And when they hear truth, they perk up and they're like, wait a second, what's the rule? All right. We call that a loophole, right? I call that an incentive. So that you
being
stay
smart. Yeah. What I love about your firm is that you look at the investment from several angles, from asset protection, from tax benefits and so forth. And you guys are all investors, so you look at it from that perspective too. So I know you guys, we're out of time. You offer classes on this, so we'll make sure that's in the show notes so that people can figure out how to find you and look for your next seminar. And we'll have you back.
We love your people. We love your heart. That's the thing that I see. I see all the folks that I meet from your organization, Kathy, just absolutely great people. It just, as a kudos to you. I work with a lot of other groups where they're very, they're just kind of the dollars, but you guys seem to actually have heart. So I really enjoy that.
Oh, thank you. Yeah, I was actually totally shocked in March and April when, people were losing their jobs, not anything to do with the job that they did. It was to no fault of their own, and having, struggling with their rent. And we had so many of our investors say, oh, it's okay. It's okay. They can, they can waive their money. It turns out that people were able to pay their rent because of stimulus, but we had so many landlords saying we want to help them out in any way that we can.
We need more people like that. we need so much housing in this country.
Absolutely.
It's really bad. Next year is going to be even worse.
Even worse. And unfortunately, these solutions are actually the problem. All these stimulus checks, all these things that we're doing, bailing companies out, is only increasing the divide. I got a negative review on my other podcast saying, these ideas are going to ruin housing, because it's like, look, these are not my ideas. These are ideas passed in Congress or by one elected official or an unelected official with the Federal Reserve that makes a decision on unlimited stimulus. You can either basically there's going to be a divide, and you've got to decide which side you're going to be on. If you don't follow, it's like a surfer. I can't control the tides, but I know when I'm going to go out and surf, and I know how I'm going to avoid crashing in the rocks by going out at the wrong time. So we're not controlling these things. We're just riding the wave. Absolutely. You're going to be on one side of the divide. Choose the divide. Do you want to be on the haves or the have-nots? It's that simple.
Kathy, one last fact that you may already know, but almost 23% of all the money, all the US dollars in circulation were printed in this last year. Because that Federal Reserve, that quantitative easing, and all the stimulus, we're talking about trillions of dollars were created.
And people are like, where's my next stimulus? Where's my, we do need to lock down. Where's my next stimulus? And without understanding the impact that is going to create more of a divide between the wealthy and those who, if you don't own assets in this environment, you're going to be hurt. That's just how it is.
Amen. Amen.
So that's what we're doing. We're trying to help people understand that. All right. Well, thank you so much for being here again on the Real Wealth Show. I can't wait to have you back, and hopefully we can do a few webinars to dive in much deeper. You guys are brilliant. Thank you so much.
Thanks, Kathy.
And thank you for joining me here on the Real Wealth Show. You can listen to this and any past episodes at realwealthshow.com. All right. Thanks again for joining me, and we'll see you next time. Bye-bye.